and later we'll conduct a question-and-answer session. Instructions will be given at that time. If anyone should require assistance during today's conference, please press star then 0. As a reminder, ladies and gentlemen, this conference is being recorded. I would like to introduce your host, Mr. Mike Flanagan. Sir, you may begin.
Hello and welcome. I'm Mike Flanagan, partner and chair of Foley's food industry team, and I'm pleased to welcome you to the Newsfeed quarterly web conference series. Today's program will focus on U.S. and European food and beverage M&A trends and issues. We apologize for the technical glitch that inconvenienced those of you participating in the United States. We're happy that you were able to log back in. We have what I believe will be an outstanding program today. Chairing our program will be my partner, Jim Peterson. Jim is a partner in Foley's Milwaukee office and is a member of the firm's private equity and venture capital, transactional and securities, and international practices, and he's a member of our food industry team. Jim's practice includes acquisitions, divestitures, investment of private equity and venture capital funds, and general corporate law. He represents private equity acquirers as well as emerging and mature businesses, and he regularly advises food industry clients on mergers and acquisitions. Before I turn the program over to Jim, I'd like to go over just a few housekeeping items. The program will last approximately 1 hour. We encourage you to ask questions throughout the program. Simply click Q&A on the menu bar and type your question. Foley will apply for 1 hour of CLE credit after the web conference. If you'd like to receive CLE credit and haven't already provided your state and bar number to us when you registered, please forward this information to zrahim@foley.com. Finally, today's program is being recorded and will be available on Foley's website. Now I'm very pleased to turn today's program over to Jim Peterson.
Thank you, Mike, and good afternoon to our European participants, and good morning to our participants in the States. I'd like to introduce our presenters, other than myself. Mike, thank you very much for the nice introduction. I will start with Jim Bertram. Jim is the head of consumer and retail investment banking at William Blair & Company and spends most of his time doing transactions for clients in the food and beverage sector. He has been at William Blair for over 5 years. And prior to joining Blair, he ran Bank of America's food and beverage practice for over 7 years. Today, Jim will address M&A and valuation trends in the food and beverage sector. Our second group of presenters are from our friends at Eversheds. That's Catherine Ely and Teresa Marie Stadel. Catherine is a corporate partner at Eversheds and a member of the international food and beverage sector. Teresa Marie is an associate in the Eversheds corporate practice and also a key member of the Eversheds food and beverage sector. Catherine will comment on deal activity in the UK and wider Europe over the past 12 to 18 months, offering some reasons behind the level of M&A activity and then giving some examples of deals concluded. Teresa Marie will then highlight some key issues which are of particular relevance to companies undertaking M&A activities in the sector. Catherine will then briefly comment upon where she sees deal activity going in the next 12 months. And I will be batting cleanup, and my presentation will address an area of risk that may not be on your radar screen, but I think should be. And with that, I will turn it over to Jim Bertram.
Thank you, Jim. Maybe where I'll start is with just a real quick overview of William Blair & Company for those who don't know the firm. We are a global full-service investment banking firm that's headquartered in Chicago, Illinois. The firm has been around for 76 years, and during that entire time has been owned and operated as a private partnership, which in today's world makes us a bit unique. When I say full service, you can see it's everything in investment banking, equity capital raising, M&A advisory work, debt capital raising, as well as equity research, brokerage, and asset management. Firm has a very strong position capital-wise, no debt, and a lot of equity capital. From an M&A perspective, on the right-hand side of the page, about midway down, you can see over the last 5 years we've done over 300 M&A transactions for roughly $100 billion in deal value. Interestingly, since we have a group of participants from all over the world, about a third of our M&A business is cross-border in some way, shape, or form, and you can see where we have offices. Moving to the next slide, as it specifically relates to food and beverage, here are 12 recent transactions that we've been involved with. Food and beverage is a key area of focus for our firm. Interestingly, on this page, of the 12 deals 5 of them are cross-border in some way, shape, or form. We recently sold the Europe's Best business, which was a Canadian frozen fruits and vegetable business that Smucker's owned. We divested that and sold it to Hain. We sold Keystone Baking, which was a U.S.-based frozen baked goods business, to George Weston in Canada. Just to the right of that, second row down, KXL is a Chinese distribution business that Rich Products owned that we sold to China merchants, and Best Brands was a U.S. baked goods business we sold to CSM. That's just to the right of KLX. And then lastly, in the bottom row there, two over from the left, Monterey Gourmet Foods was a publicly traded company here in the U.S. that we sold to a South Korean publicly traded company, Puma One. So with that, let me move into the content. Just start by saying that food stocks have held up very nicely in an otherwise choppy market. I guess that's not surprising given the defensive nature of food stocks and the heavy cash flow that they generate. You can see we looked at it both in the U.S. and on the right-hand side of the page in Europe, looked at the S&P Food Index versus the S&P 500, and interestingly against the financial sector. You can see the food stocks, both in the U.S. and Europe, up about 7% through October 25th, with the broader index in the U.S. up 4%, the broader index in Europe down almost 11%, and then the financial sector, of course, getting beaten up pretty good over that period of time, in particular in Europe. Taking a look at valuation statistics, and in this sector, both public investors as well as M&A purchasers tend to focus on enterprise value to trailing 12-month EBITDA statistics. Occasionally the public investors look to forward EBITDA multiples as well as price-to-earnings ratios, but in an M&A context, it tends to be largely focused on trailing 12-month EBITDA. So enterprise value, I think as most of you know, is the value of the equity plus the value of the debt, net of any cash on the balance sheet. So essentially the purchase price on a debt-free, cash-free basis, divided by LTM is just latest 12 months, and then EBITDA is operating profit plus D&A. Work through all the banker acronyms that we have. This page is broken into 3 sections. You can see on the left-hand side of the page on the top, looking at that statistic over time, about a 5-year period for the large cap companies. In the top right-hand corner, you can see the median multiple over that period of time is just under 10 times. And large cap food stocks very, very consistently trade between, right around 10 times, between 9 and 11 times, but usually right around 10 times. Mid-cap stocks, you can see over that same period of time, that's the middle section of the page, is measured by $1 billion of market cap up to $5 billion of market cap. Again, fairly tight range, right around that same, spot. And then the smaller cap stocks have over time traded at a bit of a discount to the larger cap companies, just given the additional risk profile that a smaller industry participant has in a large consolidated industry like the food sector. So there you can see the median over that roughly 5-year period is 8.8 times. Interestingly, in all 3 cases, stocks are currently trading at a multiple that's above that median trading multiple. So again, the stocks are trading at good, strong valuations given how attractive they are in an otherwise volatile world. Taking a look at, on the next slide, announced M&A volume statistics. The top half of the page is number of transactions. On the left you have that number globally. On the right you have that number in the U.S. specifically. And then the bottom half of the page is dollar volume. If you look at the United States, because I think it's certainly something that we live through here at Blair, looking at the number of transactions, so the top right-hand corner there, really 06 was kind of a high water mark, and then you had a decrease in volume in 07, 08, and into 09. And when we look at some commodity price graphs back a little bit further in this presentation, I'll explain much of what was happening during that period of time. As the commodity prices, in particular the grains and the oil, spiked, you had food companies reeling to adjust their businesses and adjust pricing with consumers, et cetera, to try to pass that along. So a lot of inward focus, and it brought M&A activity to a screeching halt. Right as that started to abate, the markets, in late 08 and 09, were still suffering pretty dramatically. So we didn't see a pickup in M&A activity, certainly in the U.S., until 2010. You can see, from a global perspective, it was a little bit more stable than in the U.S. We saw a pickup in 10. That was a result of, for the first time, you had food companies that were healthy again in terms of stabilizing their businesses, the market conditions were improving, and you had the threat of a tax law change at the end of the year looming, which prompted a lot of sellers to look to try to get something done in 2010. Just to the right of that, you can see that year-to-date this year, those are the two green bars, year-to-date stats for 2011 and 2010 were about flat. Interesting, if you go down below that and look at it on a dollar volume basis, what we've seen this year is a lot less dollar volume. So same number of deals, just smaller deals that are taking place. And then the last point I would make on this slide is that you can see a spike in dollar volume both globally and in the U.S. for 2008. We just remind people that was the year that you had a combination of InBev's acquisition of Anheuser-Busch for $60 billion and Mars' acquisition of Wrigley for $22 billion, as footnoted. So a fair amount of activity this year. And last, we expect that 2012 will be another active year, and we'll talk a little bit more about why that is as we get further in the presentation. So on the next slide, looking at the same statistic, that is enterprise value to EBITDA multiples, this time in an M&A or a transactional context. We bifurcated into food transactions on the top half of the slide and then beverage transactions, the bottom half of the slide. We do the best with what we can gather through publicly available information to get these statistics. You can see that the median over this period of time, roughly a 10-year period of time, is 9.4 times, and this is transactions of all sizes, large and small, where there's information available. Year-to-date, we're running at about 9.5 times on average for the transactions we've seen, so right on top of the median. Interestingly, from a beverage perspective, you can see the median's about 2 turns higher than food, and that over time we've seen that beverage businesses tend to trade at higher multiples. A lot of them have good, strong growth characteristics. Certainly the spirits businesses have historically traded at very rich valuations. 08, you can see the bottom half of the page in 2008 that the beverage multiple average was 17.3. You had the Anheuser-Busch deal that was in that, and that was a high multiple transaction as well as a number of spirits transactions. Again, relatively consistent over time. You do run into an issue of the size of the sample set as we look at this, and that's a bit of an issue with the beverage number in 2011 year-to-date. You also have the impact of one of the transactions in that average of 9.4 for 2011 year-to-date is Clement Pappas, which is a private label juice business here in the U.S. that sold for about 6.5 times EBITDA. So shifting quickly to what are the issues that we have seen that have an impact on the amount of activity in the space and will likely have an impact going forward. It's really commodity prices, tax law changes in the U.S. that had an impact in 10 and we think will have an impact next year potentially. We've also recently seen a fair amount of deconsolidation and then, of course, global expansion really going both ways. That being, folks looking to get into mature markets like the U.S., but then also the large U.S. food companies wanting to expand their footprint in emerging higher growth markets. The next slide just highlights the point I made before about the commodity prices over the last 5 years, and you can really see the dramatic spike that many of you probably lived through with corn and wheat and the oils in particular between 07 and 08. And it had a dramatic impact on the amount of activity that we saw. Sugar, it took a while for it to join in the game of rapid increases, but that happened in 09 and then again in 10, and it's bounced around. So there are a number of different commodities. We just picked a few to look at, but really as we're out talking to food companies who are thinking about doing things, you know, where we are in this cycle, where they are in their as a result, where their margins are really dictates how they're feeling about either being a seller or a buyer. The next slide has a lot of numbers on it. Really all this is an illustration of the impact on after-tax proceeds that changes in capital gains rates can have. So across the top of the page, you can see we've looked at capital gains tax rates ranging from 15%, where it is today, all the way up to 35%, where it was rumored to potentially go to when there was, you know, the threat of a tax law change in 2010. That again is up for discussion at the end of 2012. And so what we did is just work through an example where you have a company doing the EBITDA of $25 million. If you look at the far left column, an 8 times multiple is enterprise value or purchase price of $200 million. If the business had $50 million of net debt, that's $150 million to the equity holders. If you assume that the business had been around a while and had a low tax basis of $25 million, you know, the taxable gain associated with that would be $125. At a 15% rate, that's just under $19 million of taxes, yielding after-tax proceeds of $131.3. What we did is we just held the after-tax proceeds constant while moving up the assumed tax rate to back into the implied EBITDA multiple that you would have to achieve to break even from an after-tax proceeds perspective. And you can see that ranges all the way up to, it's the third line from the top, 9.5 times, or up about 20%. So as potential sellers worked their way through this math in 2010, it provided an impetus to consider doing something out in front of a tax law change. There is the chance that this, you know, is a driver next year as people think about trying to get out ahead of it. Shifting gears then to the deconsolidation activity that we've seen in the food sector, we've listed on this slide just some examples of recent divestiture announcements. Sara Lee has been very active at disaggregating itself through the sale of businesses really all over the globe. Cargill sold their flavor systems business to Kerry, who's looking to expand their platform in the U.S. Green Mountain got out of a food service coffee business that they had inherited with the acquisition of Van Hoot. Grupo Tropicana, Tampico sold a beverage business to Coke. P&G got out of their last food asset, that was Pringles. They did that through a reverse Morris Trust transaction, the third time they've done that. They sold 2 other food assets, their coffee business and their peanut butter and oils business, to both of those to Smuckers in previous RMT transactions. So you can see a number of examples of those. The other thing that we've seen this year that's been kind of interesting, a lot of these in the Midwestern states here in the U.S., is deconsolidation through spin-offs and split-offs. And here again are a few examples. Fortune Brands is taken a number of different businesses and either sold them off or split them off to really get focused on the Beam Spirits business. Foster's getting out of their wine business through spinning off Treasury Wine Estates. Kraft, as everybody knows, right after amalgamating and getting into the global confection business through the Cadbury acquisition, now splitting into 2 businesses. Raw Corp splitting into 2 businesses right on the heels of the offer from ConAgra. And then lastly, Sara Lee splitting themselves into a North American meats business and an international coffee business. And then the last concept is that of cross-border activity. As I said, we've seen and been a part of a lot of this. I'm not going to take you guys through all these. I think all these slides are available to download and to keep, and you can look through them at your leisure. But again, a lot of activity, and as I said before, going both ways, where you have U.S. acquirers looking for growth outside the U.S. and then also international buyers looking to bulk up their U.S. presence. So Jim, I think with that, maybe I'll pass the baton.
Great, thank you, Jim. And I'll pass it over to my friends at Beverage. Take it away.
Thank you very much, Jim. Well, good morning or good afternoon, ladies and gentlemen, depending obviously on where in the world you are at the moment. As Jim said in his introduction, I'm Catherine Ely, a corporate partner at the international law firm Eversheds and a member of our international food and beverage sector. And I'm joined today by my colleague Teresa Marie Stodell, as Jim said, a corporate associate and also a key member of Eversheds' international food and beverage team. Over the next 15 minutes, we're going to comment on the level of M&A activity in the food and beverage sector, both in the UK and wider Europe over the past 12 to 18 months, offering some explanations as to why the level of activity is at the level that it's at, highlighting some of the deals that have been concluded, both those on which Eversheds have been involved and others. Teresa Marie will then highlight some key due diligence issues which we see cropping up time and time again on deals in this sector. And finally, I'll conclude with a few comments on where we see activity going in the next 12 months. Okay, so focusing firstly on the current climate. Well, I think it's fair to say that M&A levels in the food and beverage sector, both in the UK and in wider Europe, are at a relatively high level, and that's particularly so when compared to M&A activity in other sectors. If you go back as far as quarter one 2008, we're seeing, and the statistics show, that between quarter one 2008 and quarter one 2011, there were generally over 100 deals a quarter that were publicised in this sector. To give you some examples of recent transactions, well, there was the acquisition of Uniq by Greencore, more seen as a takeover by Greencore of Uniq. Then there was the acquisition by Glisten plc, an AIM-listed food group, on its recommended takeover by Helsinki-listed Raisio plc. Another recent example is R&R Ice Cream's acquisition of Roland Ice Cream, France's third largest ice cream maker, which deal makes R&R Ice Cream actually the number 2 ice cream group in terms of supermarket sales in the UK, Germany and France. Bacavor's recent disposal of its French subsidiary, Bacavor Traiteur, a fish spread business that was sold to Alfesca HF, a leading European producer and supplier of convenience, fine seafood and premium products to retailers and food service providers. Another example, Lion Capital's acquisition of the French company Picard-Surgelais SA. The rationale really for that seems to be to build up a portfolio in the frozen food sector. And on a similar theme, Birdseye's recent acquisition of Findus. Finally, but by no means least, by way of examples, is the recent takeover of Northern Foods by the Boparan Group. So what are the reasons behind this level of activity? Well, I think there's obviously a lot of differing reasons. I think some deals can be seen to be sort of led by the need to consolidate global market positions with the associated capture of revenue and cost synergies. Perhaps the acquisition of Cadbury by Kraft being an example of that. Then using the economic downturn really to perhaps to effect opportunistic takeovers of undervalued PLCs or more general distressed asset purchases. And perhaps the example that I mentioned a few moments ago of Greencore's takeover of Uniq may be seen as an example of that. Other examples, well, acquisitions of companies that are resilient to macroeconomic shocks. As we all know, I'm sure, certain subsectors within food and are more resilient or seem to be more resilient to the downturns in economic activity, such as the frozen food sector. And Lion Capital's acquisition of Picard-Surgelais that I mentioned and the Birdseye acquisition of Findus could perhaps be seen as examples of that rationale. it might be as simplistic as companies wishing to dispose of non-core businesses, for example, Bakkavor's sale of its fish spreads business. And a final possible reason, realignment, companies wishing to realign their focus onto health and wellness products, with ever stories in the media, etc., about the attractiveness of that particular sector. So I'm now going to hand over to Teresa Marie, who will spend the next 5 to 10 minutes going through what we see as some key due diligence issues which have a particular impact upon food and beverage companies.
Thank you, Catherine. For the next part of our talk, we thought it would be useful to highlight some topics which we think will be of particular relevance for deals in this sector. The topics that we will highlight are the impact of the new agency worker regulations across Europe, the new food labelling legislation, the impact of antitrust competition law on getting deals done, and finally taking a quick look at a recent transaction which Catherine has already mentioned, being the takeover of Uniq by Greencore, and looking at, in that context, how pensions was a real issue there as the deal driver. So if we look firstly at agency workers. The agency workers regulations came into effect in the UK on the 1st of October 2011, so it's very recent new law here. And the regulations are intended to give effect to the European Temporary Agency Workers Directive, which member states across Europe have until the 5th of December 2011 to implement. The key requirements of the directive are that the basic provision of working and employment conditions for assigned temporary workers are no less favourable than if they've been recruited direct by the hirer. And this covers everything from remuneration, paid holiday, working hours, overtime, maternity and anti-discrimination provisions. Arguably, it also includes pension contributions. Apologies for that, everyone. That was the Evershed's fire alarm, which is clearly working. So going back to the Temporary Agency Workers Directive, in the UK there is a 12-week qualifying period for this right, and it also includes equal access for temporary workers to employment, collective facilities and vocational training. And critically, there are very strict penalties for non-compliance by temporary work agencies and the actual hirers themselves, which can be really expedited because fines are on a per breach, i.e. potentially per employee basis. So, relevance for companies within the food sector. Well, our view is that this is a real due diligence issue. Given that it's new law, buyers are likely to be really hot on it as part of the due diligence exercise. In our experience, I think it would be fair to say that food and beverage companies tend to engage a higher proportion of agency workers than perhaps in other sectors due to the nature of the work and the seasonality. So it's certainly something that companies need to have a thorough understanding of and be ready to react to as part of due diligence. Looking next then at food labelling, as you may be aware, food labelling law is harmonised across the European Union. And in the UK, the rules are implemented by the Food Labelling Regulations 1996. I think it's generally accepted that a lot of that legislation was somewhat out of date and didn't really address current requirements. So in 2008, the European Commission proposed a regulation consolidating and modernising EU food labelling rules. The new regulation was adopted in July 2011. The regulation includes a number of new requirements, including mandatory key nutrition information for all pre-packed foods. There's also important new distance selling requirements coming in, which apply if food and drink is sold via distance selling methods, such as websites or catalogues, and the seller must provide the mandatory food information before the purchase is concluded. So that is actually on the website within the catalogue itself. They've also extended the requirements to include allergen information must be provided on non-pre-packed foods. That includes food sold in restaurants. And the European Commission has been extremely stringent to go as far as to demand mandatory font sizes that the nutrition information has to have, on the basis that they're very concerned that consumers shouldn't have to work out what the impact on their health is by having to get out a magnifying glass to read what the packet of food is going to do to them. They're also extending the country of origin or provenance labelling requirements to include further categories of meat. In terms of timing, food businesses will have 3 years to comply with the rules, and they then have an additional 2 years to comply with the rules on nutrition labelling. And I guess the analysis and impact of that is obviously that food businesses should review the regulation in detail in order to plan labelling changes well in advance, and obviously to coordinate that with previously planned relabelling cycles, such as a rebranding exercise across the group. And although obviously, as ever, they will incur additional costs in having to comply with the new regulations, the 3 to 5 year implementation period hopefully will allow for such costs to be spread out. It's also noteworthy that the regulation will affect distant sellers of food and drink. As I said earlier, their websites and catalogues will need to provide the mandatory food information. This will affect, in particular, importers of food and drink from non-European Union countries, where the label may not necessarily include mandatory food information required under European Union law. So again, it's something that businesses across Europe need to review their agreements with their suppliers to ensure that the supplier provides the relevant information they need, even if it's not required under their own non-EU law. Turning then just to have a brief look at the impact of antitrust and competition law on getting deals done. There's not new law here as such, but we just feel that with consolidation an ever-present driver in this sector, trying to get deals done, you're inevitably faced with the restrictions of competition law. And I think there's just 3 things that I just wanted to highlight here. First of all, it's very important as part of due diligence that the impact of competition law, and in particular merger control, is dealt with upfront before significant costs are incurred on either side, so that we understand the impact of being able to progress with the transaction. Particularly where you're doing multi-jurisdictional deals across Europe, or indeed more widely internationally, there are different triggers and different thresholds and subtly different procedures which have to be followed through in each of those jurisdictions, which again need to be understood in detail. It could be the case that if those thresholds are met, then obviously you may need to get third-party clearance or competition authority approval to proceed with the acquisition. What's the impact on that? Well, it can have an impact on timing and deal structure, because typically what we'll see is that you'll have to proceed down the route of having a contract where the deal is structured along the lines of a split between exchange and completion, or between, as some people may refer to it, as between signing and closing. This adds a level of complexity from a legal advisor's perspective in terms of the actual content of the contract. You have to build in a lot of protections for both sides to ensure clarity as to, for example, how the business is run during that period between signing and closing, during which time you're off to try and get your third-party competition authority approval to the deal. This can increase the length of time for being able to actually get the deal done in terms of the negotiations. It can also increase deal costs quite dramatically at times. The third point I just wanted to draw attention to on that was just the potential, and again it comes back to if you're having a proper look at the antitrust impact on the deal from the outset, look at how potentially the deal might be restructured. So for example, if you're buying a company that has divisions across Europe, where perhaps the competition law in the country where the division is least important, but the law in that area is the most difficult perhaps to have to deal with from a timing perspective, could the deal potentially be restructured as an asset acquisition rather than a share acquisition, so that you could proceed with a more straightforward and important bit of the deal more quickly, and then deal with the acquisition of the more minor element of the business separately. Turning then finally just to the deal that Catherine's mentioned, it's the £113 million takeover of Uniq by Greencore. Uniq is the maker of Marks & Spencer sandwiches and desserts, and Greencore is a leading international producer of convenience foods. And we just wanted to highlight this deal because we thought it was quite interesting here. You've got a company, Uniq, which had a very large deficit to its final salary pension scheme. What had happened there was that in conjunction with the trustees of the scheme and the pensions regulator, the pension scheme actually ended up taking a majority stake in Uniq in exchange for being able to work around the level of debt due to the pension scheme. And as such, the pension scheme led by the trustees actually became the driving force there in the sale to Greencore. So I think what we take away from that is just that not necessarily that final salary pension schemes are more prevalent in companies in the food sector, but I guess it's just an example of how, in the difficult times that we're now operating in, how drivers to deals can come from places where previously we might have not seen them come from. So then that's the key area that I just wanted to draw on. So I'll just hand you back to Catherine now, who's just going to wrap up from the European perspective.
Thanks, Teresa Marie. So very briefly, where do we think M&A activity in Europe is likely to go in the next 12 months? Well, various surveys have been undertaken on this particular topic. I'm sure you won't be surprised to know. And it is pleasing to note that at the worst, respondents seem to be neutral as to activity levels, but a slight majority do appear generally to be optimistic, or indeed, in some cases, very optimistic. As Evershed, we are cautiously optimistic. I think the reasons behind the level of M&A activity over the past 12 to 18 months are still all relevant. I think deal timescales will undoubtedly not be quick, and I think investors will continue to be discerning as to which subsectors of the food and beverage sector are of attraction. Those companies or subsectors which are seen as offering something innovative and or products which are resilient to economic downturns are likely to continue to be attractive. And if they have an international aspect to their business, then so much the better. So thank you very much for your time. I'll now hand over to Jim Peterson.
Thank you, Catherine and Teresa Marie. I appreciate it. I will have to look into further what these fish spread products are that you were talking about. I'm not sure that I can find them in my local supermarket, but I will look. Because the presenters prior to me have done such a nice job hitting general topics, I thought I would focus rather laser-like on a topic that may not be on your radar screen, but should be as you start undertaking M&A activity. There are two areas in particular, FCPA and export controls. FCPA, for those of you who haven't been inundated by these definitions, I'll give you the definition and its application, and that is any company that's located in the United States or a company with securities traded on a U.S. exchange is subject to the Foreign Corrupt Practices Act, which is also known as FCPA. The FCPA generally prohibits U.S. companies, their subsidiaries, and their officers, directors, employees, and agents from offering anything of value to a foreign official in order to obtain or retain business or to secure any improper business advantage. Oftentimes these things are known as bribes. The statute also requires issuers to keep books and records that accurately reflect the disposition of company assets and to maintain sufficient internal controls. Export controls, on the other hand, are primarily sanctions compliance as administered by the Office of Foreign Asset Control, and that would relate to selling goods or services to a prohibited country or an individual, specifically designated national, without the proper notice or license. All export food from the U.S. must comply with USDA and FDA requirements as the issuance of export certificates. But as an example of how quickly the law in this area changes, I originally thought export controls would be an excellent topic for this presentation because of many companies' sales into the Middle East, particularly into Iran. But on October 12, 2011, so just a couple of weeks ago, the OFAC published the final notice of rules which permitted exports of most foods to Iran and Sudan. So the cautionary tale there is just keep one eye on rules because they do change specifically related to different companies that come in and out of favor. For example, Syria will come in and out of favor. Iraq, Libya are good examples as well. So therefore, I'll spend most of my time discussing FCPA. So why are these areas of particular areas of increased risk for the M&A practitioner in the food and beverage sector? First is that the increasing global nature of food and beverage companies, particularly those companies that are engaged in ingredients manufacture and sale, have seen their products being sold increasingly on a worldwide basis. Secondly, there's been an increased enforcement in this area. According to the DOJ, 1/3 of all FCPA enforcements have come out of the M&A context. That's both in the diligence and transactional process. Even more have arisen out of post-acquisition integration procedures. In 2008, there were 145 DOJ investigations, which was, I think, was the last year that I was able to find reported statistics. Increased penalties is the next item. As few as 4 years ago, business people would oftentimes assess the risk associated with FCPA and say they would continue the business and just pay the fine and continue on with the business. That's no longer the case because statutory maximum fines have quintupled since that time. And there have been a couple of poster children for the large fines that sometimes are assessed in these areas. Lloyd's Bank was recently fined or forfeited $350 million for an OFAC violation, which related to scrubbing certain data from wire transfers in order to disguise where payments were being made. And then the largest fine was the $1.6 billion, which was forfeited by Siemens for European and U.S. Related violations. Also, there is now a potential for criminal penalties, including prosecution of individuals. The U.S. government has found that nothing grabs people's attention quite like the potential of going to jail. So they have increased the number of individuals that they're willing to prosecute for FCP and export control violations. I think the statistics were is that there were 522 months of jail time for 38 convictions for EAR, which are export control violations recently. And then lastly, the cost of implementation of compliance programs after acquisition can be quite high depending upon the posture of the company that's been acquired. In the case of Siemens, in speaking to Siemens individuals, they indicated that Siemens has spent $125 million in compliance costs following those fines being levied. The next area, and why these are important areas to be aware of, the increased focus on China. And that's principally an FCPA risk for food and beverage companies. Number one, because of the size of the Chinese market. And secondly, because of the higher likelihood that in other jurisdictions that an entity that you'll be dealing with will have some government relation, either as part owner or some other affiliation that needs to be minded. The next item, and this is of particular concern, is that these types of violations may be difficult to detect in the M&A context. Now, it's different than an environmental review that you might perform on a company where you could order a phase 1 or dig some holes and do a phase 2. How are you able, as an M&A professional, to determine the level of risk for FCPA violations without doing an internal review or a full-blown compliance audit in a target company? Oftentimes, the target is going to be a little bit reluctant to have you do a full compliance review. So how are you going to perform that absent that ability? I'll provide some examples later on things that you can take a look at. Next is the likelihood of impermissible payments at ports. Considering the nature and the perishable nature of food and beverage products, it's often necessary to expedite shipments through ports onto their final destination. You have to be mindful of what types of payments or facilitations will be made in order to get products moved through ports. Next is the potential loss of business. If you acquire a business but then are required to not sell to potential markets because of FCPA violations or export control violations that have occurred in the past, consider that you may have paid too much for a business that would for sales that no longer exist. And then lastly is, in certain cases, the Department of Justice has disregarded change of control and penalized an acquirer for the actions of an acquired entity. At very least, the DOJ has a lot of discretion to pursue these cases, and if you're in the discussions with the DOJ, that's not a place you want to be in any regard, even if you have a good defense. So the next thing I'll do is I'll give you an example of a recent case and how this has come up, and this is the Tyson's Food case. And that's an affiliate of Tyson's Food with operations in Mexico was providing improper payments to veterinarians who were employed to inspect chicken processed primarily for export. These payments were made, as it was reported in the New York Times, so that inspectors wouldn't make any problems. The difficult issue for the M&A practitioner is that these payments are obviously not identified in the books of the company as bribes or something as blatantly obvious as that. The payments were initially made to the spouses of the veterinarians as payments made or salaries, and were later moved to the payments made directly to the veterinarians. Tyson was able to identify and decided to self-disclose these items, but only after hiring counsel and undergoing an internal investigation. Tyson's resolved these issues by paying, as I noted here, $5.2 million in fines after the self-disclosure, and the fines were levied by both the SEC and the DOJ. So now that I've identified the risk and potential damage, let's go now to identifying these risk areas in the diligence process and M&A context, and I've broken it down into three main steps. The first is to do a broad assessment of the FCPA and export control risks of a potential target. And I've got a bunch of items that are listed here that you can go through when doing your diligence on a target. So consider whether the target does business in high-risk countries, China, India, Russia, or the Middle East, or any countries in the Middle East, which could be seen as a conduit to different locations that may be under export control. Determine if the target's customers include foreign governments as customers or have substantial governmental contacts. Next is determine whether the ownership structure, overall reputation, when you do your Google searches and background searches on the target companies, lends to an increased risk. Request copies of export and FCPA control policies. And that's something when I looked at my diligence checklist for deals done even a few years ago, that would have been something buried on page 14 or 15 of the diligence checklist. But depending upon the profile of the company, it's something that you may want to make sure receives high attention early on in the process. And then lastly, determine where a target sells the product, including if products are sold through a distributor. Check the distributor's territories that have been granted to it to see if they contain any of the countries that I previously identified as having certain problems. Step two. So if you have determined that a target presents potential FCPA or export control risks, you want to up the level of your diligence and undertake a comprehensive diligence plan. Now this would include, as I've listed here, financial statement and books and records review related to searching for and identifying auditor issues and internal issues in the controls and adequacy of records necessary to create the financial statement. Consider requiring the prospective target to complete an FCPA or export control questionnaire. You'll work with your law firm to create a customized checklist that can be used for the target so you can better assess what the level of risk is. Take a look at the contracts and relationships to third parties to see where products are being sold and how they're being sold. Review the implementation of FCPA export control policies and training. There's nothing worse than seeing an FCPA policy or an export control policy that makes it appear as if it's been on the shelf for 10 years, never looked at, and not customized to the nature of the company's business. It probably hasn't been reviewed and most certainly hasn't been implemented or educated as to the workforce at the target company. Lastly, take a look at the documents as to compliance with legal requirements of export licenses or notice. If they're selling into a company which requires an export license or notice in order to make the sales, make sure that sales are being done in compliance with those requirements. And some additional items, take a look, obviously, if there are any internal investigations, take a look at the internal investigations and related results. You may want to consider hiring outside counsel to take a deeper dive into reviewing the target company. Foley has products that we sell to clients which are export control and FCPA reviews, and those are done on what we call a green light, yellow light, red light basis, depending upon the nature of the risk associated with the company that's being reviewed, and those are done on a flat fee basis. And I know that our friends at Evershed have similar reviews that they're happy to conduct on your behalf on targets should you need additional review. Take a look at any requirements to clear or expedite items from ports, review governmental inquiries and the target's responses to governmental agencies, take a look at their political, charitable, community programs, and take a look at their record requirements and upkeep with those requirements. So lastly, step three, what do you do if you've uncovered a violation? There's no requirement, importantly, to self-disclose in this area, but self-disclosure by both an acquirer and a target are questions that you'll want to take a look at further and whether or not self-disclosure is the best way to go. Obviously, an acquirer is going to be subject to the confidentiality rules and the confidentiality agreement, so those will have to be minded to. But the target, if they're made aware of FCPA violations, will want to think long and hard whether they self-disclose those issues. That will also have a bearing upon, or will be bared upon by whether the company is a public or private company and subject to exchange listing requirements as well. Importantly, don't place sole reliance on reps and warranties indemnification provisions. The risk may be high enough that you want to include specific walk rights if there is material risk isn't covered. Also consider specific discussions that will need to be had regarding reductions in price if sales to certain customers need to go away as a result of compliance with FCPA rules. There was a recent transaction, Elandia International's purchase of Latin Node for $20 million, a rather small transaction. But after discovering FCPA violations, Elandia allocated $18.2 million as a direct charge to cover FCPA violations, fines, costs, loss of customers, etc. Elandia then later discontinued Latin Node's operations and placed Latin Node into bankruptcy. Obviously not a good result for a $20 million acquisition. The Department of Justice expects acquiring companies to be diligent and identify FCPA issues prior to closing. And also note that actions can be taken by an acquirer to limit exposure for the target's pre-closing conduct. So you'll have to identify and deal with problematic conduct, problematic employees. You can implement the appropriate policies, procedures, training, internal controls, record keeping, reporting, and cooperation with governmental authorities in order to keep the risk or the downside of acquiring an FCPA, a company with FCA difficulties on the minimal side. You may not be able to eliminate them completely, but you'll be able to keep them as minimized as possible. And that is the end of my presentation. I'd like to now turn it over to our operator, George, to go through any questions that might have come up and open this up for a question and answer session. George?
Of course. Ladies and gentlemen, at this time, if you have a question, please press star then 1 on your touchtone telephone. Once again, if you have a question or a comment, please press star then 1. And once again, ladies and gentlemen, if you have a question, please press star then 1.
George, this is Jim Peterson. If I could break in with a question for the group, and this is for our friends at Eversheds. I hit the export control and FCPA requirements. I know the UK has adopted new regulations which are similar to that. Do you want to touch on them just briefly on the anti-bribery requirements?
Yes, thank you, Jim. I mean, you're correct that the new anti-bribery regulations have recently come into force in the UK, and certainly they are being taken very seriously by companies over here, and we're getting a lot of traction with both clients and with prospective clients in helping them devise appropriate anti-bribery policies for adoption. Where we've also seen it as well, which has caused quite a degree of alarm, but I think the British Venture Capital Association, in conjunction with the various the devisers of the legislation, have sort of acted quite quickly to sort of quell the fears. Was the fear basically that private equity houses could actually be held to be responsible under the sort of the passive bribery part of the legislation for the act of their portfolio companies. And I think the general conclusion that has been reached is that mere fact alone, the fact that a private equity organisation may have a majority stake in a company, is not by itself enough to constitute, thereby leave the private equity house open to, automatically open by that very reason alone, to be guilty of the offence of passive bribery.
I think as well, just to comment from the general pure M&A perspective, it's compliance with the anti-bribery legislation is certainly an additional question that target companies are now being asked as part of due diligence, to confirm that they comply, and also to provide copies of the procedures. So buyers are certainly expecting target companies to be up to speed with the law and to have the necessary procedures in place. And we're also seeing in the actual acquisition documentation, in addition to the usual reps and warranties around compliance with law, a whole raft of specific warranties being sought typically by buyers to confirm compliance with the bribery legislation.
Excellent. Thank you.
Thank you. I'm not showing any questions in the queue.
Okay, great. Mike, do you want to close us out? Well, I guess Mike...
no, I apologize. Sure, Jim. I'd like to thank you, Jim Bertram, and our speakers from Evershed. This wraps up the hour. We invite any of you on the line